All right, for insights on the bond market ahead of the Fed's meeting on rates, let's bring in Kelsey Berro, fixed income portfolio manager at JPMorgan Asset Management. We were scratching our heads on why the possibility of 50 basis points increased significantly in the last couple of days. What in the bond market do you think? Is there anything, signs there that indicate it might 50 might be the way that the Fed decides to move at this point, Kelsey?
Yeah, so the market right now is pricing in about a 50-50 odds that they cut 50 basis points instead of 25. And we think that Chair Powell is probably sympathetic to the 50 basis point rate cut. We don't think that the Fed wants to disappoint the market, particularly on their first policy move in 14 months. It would be quite counterproductive for the Fed when they're looking to support the economy to disappoint and tighten financial conditions. So I think if market pricing stays around here at this 50-50, the Fed is going to have to deliver on that 50 basis point rate cut. And I'm not too concerned about the concept that what does the Fed know that we don't. I really think you have to take a step back and think about where policy rates are right now. They're at least 100 to 150 basis points too restrictive. And so just doing 50 basis points to start, you know, it's just getting us on the right path back to neutral. I don't think that we're at risk of easing too soon. Inflation break-evens, for example, are falling, which is an indication that the market is seeing downside risks to both growth and inflation here.
So you can make a case that in terms of how restrictive the Fed is, you put it at least 100 basis points or even 150.
That's correct.
So that would make doing 25, it's like, you know, why do it? If you need to try to get to, is that the stated goal, to get to neutral?
I think that's what they're looking to do right now, because if you look at any kind of standard policy rule, it suggests that the progress we've made on the inflation mandate alone justifies probably 100 to 150 basis points of easing. Now, where I think the market is still very undecided is about the risk that the Fed needs to cut below neutral. Right now, the market is pricing in sharp rate cuts, but then a stabilization around 3%. To see a material leg lower in Treasury yields from here, which have already moved fairly significantly, you're going to need to see the market start to reassess the probability that the Fed actually needs to not just move back to neutral, but actually move into a significant easing territory below 2.5%, which is not something that the market is currently pricing in.
We never know what we don't know, and I think you're right that maybe this time if the Fed did go 50, I don't think that the knee-jerk reaction would be, uh-oh, what do they know? Because there's been too many data points recently that I would imagine lend credence to the notion that the economy is in pretty good shape. Is there any way there's something looming, like, you know, the Titanic, where that we all we see is the top of the ice or something? Is there anything that could be out there that could cause people concern, or would they say, okay, they're doing 50 because they want to get to neutral? I think they could do it and not really raise those fears, like you said.
Yeah, I agree. I mean, you look at the data and it's mixed. It's not, you know, all clear in one way. But I think what they see is they see a labor market that's cooling. They see payrolls growth that has slowed. The 3-month moving average for non-farm payrolls is now 116,000. That is actually right on top of the level of payrolls growth where historically the Fed has eased in the last 7 cycles. So the job growth has slowed. But, you know, the reason I think the market continues to be able to remain sanguine around the prospects for the economy is because layoffs remain low. And as a number of your guests have pointed out this morning, GDP tracking in the U.S. continues to remain robust. And what you hear from companies is, you know, things may be slowing, but nothing is falling off a cliff here. You know, the prospects of a soft landing, we can still hold on to them for now.
Hey, Kelsey, I want to bring up a quote from Stan Druckenmiller, the great investor. He was reaching out to Joe and I this morning. This is something he said we could go ahead and use. Here's what he's thinking about this whole situation. He says, I don't care if they go 25 or 50. I really don't. But I can't help but point out that right after inflation was 9% with rates at 0, they went 25 basis points, meaning up 25 basis points. Where were all the Wall Street cheerleaders who are calling for 50 because real rates are too high? The asymmetry in their narrative is striking. And I guess that just gets into the idea, do it because they can or dole it out slowly.
Well, maybe they learned something from the experience that they had on the way up. They started slow and then they had to accelerate and ultimately had to do 75 basis points hikes. And that was very jarring. So maybe, you know, at this point, they want to be looking at front loading. And it's not just something that market participants are talking about. Even in Waller's last speech that he did following the jobs report, he did discuss the concept of front loading rate cuts, similar to what they did on the way up. And maybe even we can do it a bit more efficiently than we did when inflation was viewed as transitory. Move a little bit more proactively this time, knowing that inflation has come back down and the risks are now more skewed towards not the inflation upside risks, but the downside risks to employment.
How long do you think it takes for rate cuts to work their way into the economy? On the one hand, it generally takes a while. On the other hand, we're already seeing interest rates move just on the expectation that they'll cut rates.
That's a fair point, and there isn't a precise way to measure this, but I do think that when we're thinking about the rate cuts that the Fed is going to deliver in 2024 in the last 3 meetings of the year, those are really going to be impacting the outlook for 2025. So it does take some time for them to pass through. The places where we'll see the pass through happen most quickly is, of course, in financial markets, in mortgage rates. And I suspect another area that will get a nice boost is commercial real estate, where there's a lot of risk around reinvestment. And just seeing those rates move lower is a sign to help them kind of extend the lives of some of the more troubled situations.